As we look ahead to 2025, one of the most significant trends emerging in the housing market is the rise of adjustable rate mortgages, or ARMs. These loans, which offer lower initial interest rates that can fluctuate over time, are becoming increasingly popular among homebuyers. But what does this mean for the overall stability of the housing market? In this video, we'll dive into the implications of this trend and why it's crucial for both buyers and investors to stay informed. The surge in ARM loans is noteworthy, especially as many buyers are drawn to the allure of lower monthly payments. However, this can lead to potential risks down the line, particularly if interest rates rise significantly. Understanding the dynamics of ARMs is essential, as it can impact not only individual homeowners, but also the broader economy. As we explore this topic, we'll discuss how the rise in ARMs could affect market stability, including the potential for increased foreclosures and shifts in housing demand. It's vital to grasp these market trends, as they can influence everything from home prices to lending practices. So, whether you're a first-time homebuyer, a seasoned investor, or simply curious about the housing market, this video will provide you with valuable insights. Join us as we unpack the implications of the rise in ARM loans and what it could mean for the future of real estate. Adjustable rate mortgages, commonly known as ARMs, are a type of home loan where the interest rate is not fixed but instead adjusts periodically based on market conditions. One of the key characteristics of ARMs is that they typically start with a lower interest rate compared to fixed-rate mortgages. This initial rate is often fixed for a specific period, such as 5, 7, or 10 years, after which it adjusts at regular intervals, usually annually. The way interest rates fluctuate over time is a crucial aspect of ARMs. After the initial fixed rate period, the interest rate is tied to a specific index, such as the LIBOR or the Treasury index, plus a margin set by the lender. This means that when market interest rates rise, so do the payments on the loan, which can lead to significantly higher monthly costs for borrowers. Conversely, if rates fall, borrowers may benefit from lower payments. The appeal of ARM loans is particularly pronounced in a low-rate environment. Borrowers are often attracted to the lower initial payments, which can make homeownership more accessible. This can be especially appealing for first-time homebuyers or those looking to purchase in a competitive market. However, while the initial savings can be enticing, it's essential for borrowers to consider the long-term implications of potential rate increases. Understanding how ARMs function is vital for making informed decisions in today's ever-changing housing market. As we delve into 2025, several key factors are driving the notable increase in the popularity of adjustable rate mortgages, or ARMs. One of the primary contributors is the prevailing economic conditions, particularly the low interest rate environment that has persisted in recent years. With central banks keeping rates low to boost the economy, adjustable rate mortgages are becoming more attractive to borrowers due to their lower initial rates, which can significantly cut monthly payments. The impact of these low initial rates cannot be overstated. Many homebuyers are drawn to the prospect of lower upfront costs, allowing them to afford homes that might otherwise be out of reach. This financial flexibility is especially appealing in a competitive housing market, where bidding wars can drive prices higher. Borrowers often see adjustable rate mortgages as a way to maximize their purchasing power, even if they are aware of the potential for future rate adjustments. Demographic trends also play a crucial role in the surge of ARM loans. Younger buyers, particularly millennials and Gen Z, are entering the housing market in increasing numbers. These generations tend to prioritize affordability and flexibility, making ARMs an attractive option. Additionally, many are more willing to take on the risks associated with fluctuating interest rates, especially if they plan to move or refinance within a few years. In summary, the combination of favorable economic conditions, the allure of low initial rates, and shifting demographic trends are all contributing to the rise of ARM loans in 2025, shaping the landscape of the housing market. As the popularity of adjustable rate mortgages, or ARMs, continues to grow, it's essential to consider the potential risks associated with this trend. One of the most significant dangers for ARM borrowers is the prospect of rising interest rates. When the initial fixed rate period ends, borrowers may face substantial increases in their monthly payments if market rates have risen. This sudden spike can strain household budgets, leading to financial stress for many homeowners. The potential for increased defaults and foreclosures is another critical concern. As borrowers struggle to keep up with higher payments, some may find themselves unable to meet their mortgage obligations. This could lead to a rise in foreclosures, which not only impacts individual families, but also has broader implications for the housing market. A surge in foreclosures can lead to increased inventory, driving down home prices and creating a ripple effect throughout the economy. Moreover, the reliance on ARMs can create instability in the housing market. If a significant number of borrowers default on their loans, it could undermine lender confidence and lead to tighter lending standards. This, in turn, could restrict access to credit for potential homebuyers, further slowing down the housing market. In summary, while ARMs may offer short-term benefits, the risks associated with rising interest rates, potential defaults, and the broader implications for market stability cannot be overlooked. Understanding these risks is crucial for both borrowers and investors navigating the evolving landscape of the housing market. As we analyze the current landscape of adjustable rate mortgages, or ARMs, it's crucial to examine the signs that may indicate a potential market implosion. Historical precedents provide valuable insights. The housing crisis of 2008 serves as a stark reminder of how the proliferation of risky mortgage products, including ARMs, can lead to catastrophic consequences. During that period, many borrowers faced skyrocketing payments as interest rates adjusted, resulting in widespread defaults and a significant downturn in the housing market. Today, several current market indicators suggest a similar instability may be brewing. For instance, rising levels of debt among borrowers, coupled with increasing home prices, are raising red flags. Many buyers are stretching their budgets to secure homes, often relying on ARMs to afford the initial costs. Additionally, a growing number of homeowners are refinancing into ARMs, which could expose them to future rate hikes and financial strain. Expert opinions on the future of the housing market vary, but many analysts express concern over the sustainability of the current trend. Some warn that if interest rates continue to rise, we could see a wave of defaults reminiscent of past crises. In summary, by examining historical precedents, identifying current market indicators, and considering expert opinions, we can better understand the potential risks associated with the current housing market dynamics. In conclusion, the rise of adjustable rate mortgages, or ARMs, in 2025 presents both opportunities and significant risks for borrowers and the housing market alike. We've discussed how the initial allure of lower interest rates can make ARMs appealing, especially in a competitive market. However, It's crucial to recognize the potential dangers associated with rising interest rates, which can lead to increased monthly payments, defaults, and foreclosures. These risks not only affect individual homeowners, but can also destabilize the broader housing market, as seen in historical precedents. As we navigate this evolving landscape, it's essential for both current and prospective homeowners to stay informed about market trends and the implications of relying on ARMs. Understanding these dynamics can empower you to make more informed financial decisions and better prepare for potential challenges ahead. If you found this discussion valuable, we encourage you to subscribe to our channel for more insights into the housing market and financial strategies. Don't forget to like this video and share it with friends or family who may benefit from understanding the complexities of ARM loans and their impact on the market. Staying informed is key to navigating the ever-changing world of real estate, and we're here to help you every step of the way. Thank you for watching, and we look forward to bringing you more valuable content in the future.